Hey, good afternoon, everyone. It is 2:25 p.m. on Saturday, August 20th, 2022. Hope everybody had a great week, having a good weekend so far. This is Forex Brizio, and so the last video I made was using cluster and footprint charts, particularly in the futures market. So if you didn't watch that video, it's pretty interesting, kind of a completely different way of trading. As I mentioned in that video, I don't really find those to be very useful in Forex trading because of the decentralized nature of it. So in Forex, I find either fundamental trading or just very simple technical analysis, or some combination of the two works best versus something like volume profiles and cluster charts, footprint charts, again, because of the decentralized nature of Forex. So today, this is going to be a Forex video, and you probably could apply this video very simply to futures and crypto and anything else, but we're going to concentrate just on Forex. This is a really straightforward, simple, fairly mechanical, non-discretionary trading methodology. Nothing magic, as I've said before. I've talked a little bit about these, about this type of setup in the past, but I've tweaked it a little bit, fine-tuned it, back-tested it a little bit more, made a couple little adjustments, and I find it works really well. If you stick to the rules, it's actually very good. And I did go back and back-test it on certain pairs, and it does work, on most pairs. Ones that are like super volatile or low volume, high volatility, they have lots of whipsawing ranges, it probably is not great on, but for the vast majority of major and minor pairs, it'll work just fine on, okay? So let's just go through. I'll show you a couple of examples. I'll try to keep this pretty short. Okay, so first of all, I recommend trading this on a 30-minute chart or higher. Nothing shorter than a 30. If you go lower than a 30, yes, you're going to get more trades, but you're going to have a lot of false signals with this too. The 30 I found is short enough so that you get ample number of entries, but it filters out most false signals. This probably would work perfectly fine on a higher time frame. So if you're looking to do more swing trading, pure swing trading, I'm sure this would work fine. Maybe you'd have to tweak some of these settings a little bit, but for the most part, I think you could just easily transfer this to a higher time frame. But so I would say, on the 30 minutes, definitely too short for scalping. But I said it's good for day to swing trading, depending how long you would like to hold trades and things like that. A 30-minute chart, I really think could go either way. Probably leans more towards swing trading, but certainly you could do this as a day trade too. Okay, so that's just my opinion, but like I said, I would not recommend going under a 30-minute chart for this, okay, irregardless of what pair you want to trade it on. 30 minutes is perfect. If you want to go higher, probably okay too. Okay, so let's just review what's on the chart, and this is very simple. No special indicators. It's just 3 moving averages. Not rocket science, but maybe a little bit different way of using them. So let's just review what these are. So this one here, this red one, is a simple 50-period EMA, exponential moving average. Put it up here on the screen. There you go, 50 exponential set to the close, no shift. And I'm saying no shift because you'll see in a minute why. So that's all this is, 50 EMA. And then these two white ones are 10-period EMAs. Only thing is, this one, the one on the top, one is set to the high, one set to the low. Okay, so I'll just show you one of them. And we'll drag this over. So 10-period exponential set to the high. The other one is set to the low. Obviously, you can pick whatever colors you want. And the difference here is I put a -2 shift. Now, normally this defaults to 0, like you saw on the 50. I put a -2, and what that does is it shifts the moving averages back, in this case -2, so it'll shift them back 2 candles to the left. And what I found is that gives you a little quicker entry, because sometimes on a 30-minute, your entries, depending how fast price is moving, could be a little bit, lagging, because these are lagging indicators, moving averages. So you could use it straight up with shift 0. It works just fine. But I found that a slight shift, -2, shifts them over to the left a tiny bit. and it doesn't really produce any more false signals, but it gets you in a little bit quicker, maybe a couple of candles quicker, which can be important on a maybe a faster moving market. Okay, so again, 2 10-period exponentials, one high, one low, both with this -2 shift. Okay, and that's it. That's all that's on here. All right, so the strategy is really simple. So I also say, guys, my prime territory for looking for trades in here, although again, in hindsight, it looks great, is when price on the 30-minute chart hits a new high or a new low. That will interest me for a potential reversal, but of course it doesn't mean it's going to reverse. It could just keep going up or keep going down. But when price reaches a new extreme on the chart, I like to pay attention to those particular pairs to see about a potential reversal. If not, I might use the same methodology to rejoin the trend on a pullback. But this is where maybe using your higher time frame analysis can help you maybe try to pick areas where maybe price will bottom out or top out and start moving the LOA. So this is a 30-minute chart. You know, if we go to a 4-hour chart and just look at this, you can see, we had ran up here and had this big red candle. But either way, you don't necessarily need to do that, and you don't necessarily need to wait for an extreme high or low. It's just that if you see one on your chart, that's forming, that it could be an area that you might want to at least keep an eye on. Okay? But that's kind of an aside. So let's just talk about the strategy, and it's really simple. What you're doing, guys, is you are waiting for both of the 10-period moving averages to cross above or below, in this case, the 50. Okay? That's pretty much it. So you can see right here on this entry, the lower one, because of course we're going down, so the low one's going to close below first. So that closed at this candle right here, or maybe even this one, depending, this one or this one. You get this one. And then you got the second one to close probably at the close of this candle right here. So this would have been your entry, about an hour or two, hour and a half, 2 hours later, you would have got your entry. So let's say you got in right here, price went down, you had a pullback. This is very common on trend reversals, guys. So you can either be more aggressive and just jump in right here and just have a bigger stop loss, or you can wait and see if the market pulls back, which is very common, and you can get in with a better fill on the pullback. I'm not going to tell you what to do either way. Sometimes it doesn't pull back and it just goes. Other times you get a tiny little pullback and it goes. Other times you're going to get a really steep pullback before it goes. So, you might run into a significant amount of drawdown, or maybe even getting stopped out depending how far it retraces. But this is a 30-minute chart, so the stop losses shouldn't be too crazy. So what I would do, if I was going to get in here, I'd put my stop above the last swing high, which would have been up here, and that would have given me plenty of room on this retracement. I would have gone into drawdown about 20 pips or so, and then it turned in my favor. I'm perfectly willing to go into 20 pips of drawdown, no problem, because I'm going to hold this trade for a while. And my stop loss would have been about 30 pips up above this high. So I'm okay with that. But that's up to you whether you want to just get in at that point as soon as you get the signal, or if you want to wait for the pullback. Understanding that sometimes you don't get the pullback, or you only get a small one or whatever, and you might miss that part of the trade. So that's depends on your risk management. Obviously, if you're going to get in and not wait for a pullback, you might want to just think about your risk management and maybe not add in such a big position size until the trend is confirmed. Okay? So anyways, this is your first entry. And then you can see what happened here. So now let's talk about how this filters out bad signals. So now, okay, so we just had come off this big uptrend, right? Over here. This had come from way down all the way up to here. And then we had this move down, and then it started to go back up. So somebody might think, well, especially when they see these big green candles, the uptrend's going to continue. But you can see there was no signal here based on this methodology, because this moving average did cross above the 50 right here, but this one never did. It came up close to it, but it never crossed. So there was no long entry. So using just that alone, you would not have taken a long position here, and you would have saved yourself a loss, because clearly it went straight down after that. Okay? So here was an entry. This was a filter to filter out a bad long right here. Let's say you didn't get this one, or maybe you did get it and you wanted to add to a position. Well, now this is your next opportunity right in here. Downtrend confirms. The lower moving average stays below. Okay, so that one's good. And then this one crosses over again right here at the close of this candle. You jump in, take your short somewhere in this area, and then we fall down. Now right here again, here's another big pullback, and you can see again, this probably was a news candle. This is the Kiwi Canadian. I think there was some Kiwi news this past week. I forget whether it was interest rate. But when you see a candle like this has probably happened during the Asian session. Let's see what time this was. Yeah, this is during the Asian session. This is 5 o'clock on my broker, which is about 10 p.m. New York time. So this happened during the Asian session. So this was probably a news candle, and it spiked up, and then it came right back. And the big traders use this as a selling point. They suck in a bunch of people to go long right here. You jump in long probably at the top, and then boom, you're immediately in a loss. But again, if you use this method, you would not have taken this trade because on neither moving average crossed above. So this is simply a pullback, and whether you took a short right here to continue or whether you just didn't take a long and avoided the trouble, you saved yourself a loss here, and probably a pretty significant loss on this news candle. Okay, this is very common. The news comes out, the big banks and large traders use this as their impetus to push price in one direction, suck in people, trigger off buy stops or trigger off stop loss orders on sells. Like people were short down here, maybe put a stop, above the recent price, and then they run it up, stop all these people out, take all that liquidity and run it down, or they suck in people to trigger a long position and then stop them out down here. So really nasty, but it's very common. And so, but if you just ignored this and just followed these moving averages, you would not have been pulled into this. And of course, the downtrend then continued, and then we had another entry down here, same thing. This one crossed above. You had this strong bullish candle, but the second one, the low one, never did, and so you would not have been sucked into this long position, and the downtrend continued. Okay, so it's pretty simple, guys. That's really the main thing. Now, as far as managing the trade, I'm not going to really get into it. There's 150 different ways to manage a trade based on when you want to get out. Do you want to get out maybe when the price pulls back and touches the 50? So if you were in a short from up here, you would have exited right here. Okay, but you could have gotten back in. Do you want to use some oscillator? Although I don't like using divergence, especially on short time frames. They generally doesn't work. That's why I don't have any indicators down here. I'm not a big divergence fan, especially in day trading. And so I wouldn't use that. So I would just use price action, whether it's pullbacks into the 50 period or, a complete reversal signal. Like if you were long up here, once you got this reversal signal, then you would exit. However you want to do it, there's a million different ways. Okay, using ATR, using, a set risk to reward ratio, a 2-to-1, 3-to-1, 10-to-1, whatever risk to reward ratio. 100 different ways to exit trades, use a trailing stop. So I'm not going to really specify. You decide how you want to do it. I'm just talking about how to enter and how to avoid false entries. Okay? But how you manage the trade once you're in is up to you. But you can see, guys, it's pretty straightforward. I'm just going to go over to the Euro Aussie for a minute. And I want to show you maybe a potential trade setting up here for next week. But again, how this filters out bad signals. So again, we had this really strong uptrend ended here. Here was your entry. Basically right here at the close of this candle, we had the first one break here, and then the second one broke here. Okay, so here was your entry. Okay, and then we can see we came down, and we talk about pullbacks in a downtrend or an uptrend. In this case, we have a sideways pullback here. Now look at the moving averages. Look at the white ones. The white one, this upper one did cross over right here and again right here. But at no time did this lower one even come close to crossing over, even on this big, strong green candle right here. So again, normally you might get sucked into this, especially if you're only using one moving average, like a regular 10-period EMA to the close. That probably closed above right here, and you would have gotten sucked into a long position here. Okay, thinking, well, this uptrend is going to continue. I see this, I'm going to get in long. Now, it is possible that this is going to continue back up. We'll see next week. If this strongly starts to move back to the upside and this lower moving average crosses up and these start to turn up, then, I will consider a long. My bias on this is that it's going to go down just based on this cross down and then this sideways action and the fact that we're just moving like this. My bias is more to the downside, but I'm not married to that. But right now there's no signal to go long or short here at all, okay, because you have a 10 period on either side of the 50. So if this turns down and we get some nice impulsive move, obviously this moving average is already below the 50, so we'd be good on that one. And we would just wait for this top one to cross down and close below the 50, okay? Wait for the candle to close, okay, before, so the moving average updates and, you get a closed candle. Don't try to jump the market, because if this is going to go down, guys, this is going to go quite a ways. And whether you get filled right here or right here, who cares, right? You still got a lot of downside potential on this trade for pips. So don't try to, be clever and jump the market, because it could just be a false break and then goes higher and you get stopped out for nothing. So wait for the candle to close and wait for that confirmation signal. It's very effective, guys. It works really well, but you do have to be patient and let the signals play out. Okay, because again, if let's say you get in somewhere over here, an initial target would be back down near these lows, which is a good 100 to 115 pips, somewhere in this range. That's a pretty good trade, and it's probably, you could go to your higher time frames and look. This thing could go a lot lower, but this would be probably an initial target right here, down here. So whether you get in right here, you still got plenty of pips to make. This is 100 plus pips from this location. And that's after it clears out all these lows too. Okay, so this is just another example of where you get an entry to go short and where this thing also protects you from taking a bad position. Okay, right in here, all this area right in here, there was never any signal to go long. In this area, if you are already short from over here, then, hopefully you didn't get stopped out here and you're just maintaining this short, and it probably will continue down. Okay, so if you're not already in the trade, I would not get in until you get a confirmation. But if you're already short from back here, you can see price try to come up and probably try to take out people that were short. Hopefully you had a stop loss for far enough away to protect you on this. But if you didn't get in, or if you did get taken out over here, just wait, because probably the bigger move is yet to come if this goes down. This was the initial push down, and then the bigger move down is still to come. So let's keep an eye on this one for next week, and maybe we'll update it. Okay? So that's really it, guys. I'm not going to beat a dead horse. Again, you can just go through your charts, and you can back test this. Again, guys, do not go lower than a 30-minute, just my advice. If you go to a 15 or even a 20-minute chart, yes, you're going to get more signals, but there's going to be more false breaks. If I go to let's see here. If I go to the 15 on this Euro Aussie we were just looking at, then I had a buy signal right here. Okay, I had a signal to go long at the close of this candle, and look what happened. It kind of, barely went up a tiny bit more, and then it came right back down, and at best you'd probably be sitting at break even right now on a trade that's probably going to turn down and turn into a loss. So this is why I say don't use the short time frames. 30 minutes good. Again, you're going to get plenty of signals, especially if you're looking at enough pairs during the week, because you can very quickly just you can see all mine are set to 30-minute. I can very quickly just click through and look at all of them a couple of times a day. I probably will look at them and decide whether there's any that maybe are setting up or maybe getting close to setting up, and I'll either set a price alarm, or I'll just at least make a note of it and just keep an eye on it throughout the day. But I'm not going to jump in until I actually get the signal. Okay, so it's pretty straightforward. So even with multiple pairs, because it's so mechanical, you can pretty much just click through and look at it. You're not doing a lot of big analysis. There's either a setup or there isn't. Okay. And that's it. And again, guys, it's not going to work 100% of the time. Sometimes you will get false breaks. These things will cross, and you'll end up reversing back. That's going to happen. But if you use the 30-minute or higher, you'll minimize those. and you'll be right more often than you're wrong. A lot of times, like anything else, it comes down to where you put your stop loss. Don't trail it too close, especially on these initial pops, because there's going to be a pullback and you don't want to get taken out just to have it run in your favor, which happens all too often, especially with newer traders, and still happens to me once in a while, because if I'm not confident on a trade and I put my stop too close, although I've gotten much better on that over time. But it's very common because, you're worrying about the money, you're worrying about losing money, you have too big of a position size on, so you're worried about getting stopped out. You got to give the trades room to breathe. If I went short over here, my stop loss would be up here. Give this thing room to run back up, run out all the shorts up here and trigger off longs. And then, that's what the banks are trying to do, and tap some liquidity, and then they'll push it down. In this case, it looks like we're probably just going to kind of range and then move, but we'll see what happens. But let's keep an eye on this one. Be a good one to update on next week. But again, guys, that's really about it. So I'm going to keep this pretty short. I can go through any pair of my chart here and find the exact same setups all over the place. And that's it. So, check it out. Back test it. Very, very easy to back test. Obviously, you can use any trading platform. These are just simple moving averages. Well, they're exponential moving averages, but they're just moving averages. In every single trading platform, no spectral indicators, no proprietary indicators, nothing to buy. You don't need anything down here for oscillators unless you really want to. I don't use them for the most part, especially on short time frames. Like I said, they don't really work very well. So I just assume keep my chart as clean as possible. This is more than enough to have on my charts. Okay? So that's it, guys. Please, share the love and, click that like button. And if you haven't subscribed, click the subscribe below the video here in the lower right corner, and then ring the bell notification icon below so you get notified when I post a new video, which is about once a week or so. And if you have any questions or comments on this or anything else, drop them in the comment section. It's always helpful. But I will leave it there. Appreciate you guys watching, and we will talk to you next week and hopefully give you some updates. Thanks, guys. Have a great rest of your weekend. Take care.